Hi, and welcome to Russell's Market Week in Review for May 14th, 2026. My name is Riti Samantha, and I'm the Global Co-Head of Fixed Income at Russell Investments. Now, before I turn to markets, and for those who might have missed it, the City of Seattle designated March 14th Russell Investments Day. So happy Russell Investments Day, everyone. This week, investors have stayed alert to renewed US-China discussions and a possible peace deal in Iran, while global trade and technology tensions have continued to shape market sentiment. Let's start with the rates markets, which actually will be a discussion on inflation. Inflation continues to run strong in the United States, with year-over-year levels just over 3.3%. At the same time, the labor market remains resilient, with 115,000 jobs added, well above the Bloomberg estimate of 65,000. That said, wage inflation remains muted. Putting all of this together, markets are increasingly pricing in a pause through the rest of 2026, with a potential rate hike now pushed into the first quarter of 2027. In terms of market moves, the 10-year Treasury yield has risen from 4.3% at the end of April to around 4.48% today, driven in part by a strong producer price index print at 6% with the sharpest monthly increase since 2022. Importantly, components of PPI, particularly healthcare and airfares, feed directly into Fed's preferred inflation measure, PCE, which will be released on May 28th. Markets will be watching this closely. Outside of the US, the UK has seen increased volatility this week. Political uncertainty surrounding Prime Minister Keir Starmer's future, combined with weaker labor market data and ongoing energy-driven inflation, has added pressure. As a result, the UK 10-year gilt yields have moved above 5%, reflecting rising inflation expectations. Turning to credit now, volatility, as we measure it by the MOVE index, which is a measure of implied bond volatility, has moderated significantly, falling from around 114 at the start of the year to roughly 70 today. In investment-grade credit, spreads have tightened modestly by about 5 basis points to 74 basis points, while high-yield spreads are hovering just around 265 basis points. Within investment-grade credit, though, we're seeing more pronounced tightening in longer duration bonds and in large cap issuers, suggesting potential for catch-up from smaller cap and shorter duration bonds. This creates some dispersion in relative value opportunities across both IG and high-yield markets. On the issuance side, activity has remained robust, particularly in AI-related sectors. April issuance was the strongest since April 2020, although much of it came through 144A private registered securities, which will not be entering benchmark indices. Notably, hyperscaler issuance has already reached approximately $150 billion in 2026, surpassing total issuance for all of 2025. We're also seeing that these issuers are expanding beyond US markets into CAD, Euro, Sterling, and more recently Japanese yen debt markets, including a yen deal from Alphabet last night. This cross-market issuance could meaningfully reshape the composition of global investment-grade credit markets over time. Finally, a quick look at two areas of growing interest: agency MBS and fallen angels in high yield. Agency MBS delivered strong performance in 2025, with returns of 8.8% compared to 7.7% for corporates. Continued support comes from Fannie Mae and Freddie Mac's $200 billion mortgage purchase program, along with expected demand from banks as regulatory constraints ease. While current spreads appear to already reflect much of this support, additional bank and overseas demand could provide further upside. In high yield fallen angels, bonds that are downgraded from investment grade credit into high yield remain a key opportunity. These securities often experience an initial overselling as they enter the smaller high yield market, but over time, as spreads normalize towards fundamentals, investors can benefit from what's known as the fallen angel premium. We've seen several notable fallen angels in 2025, including Warner Brothers and Celanese. While activity has been more balanced this year, with some offset from rising stars, names that are going from high yield into IG, the combination of low default rates and solid fundamentals continues to make this an attractive segment of the high yield market. Overall, markets are navigating a period of uncertain inflation and growth dynamics, especially in light of energy price dislocations and unclear second and third round effects on the real economy. Against that backdrop, however, we see opportunities emerging across rates, credit, and securitized assets. With that, thank you again for joining me, and please join my colleague at next week's session of Russell's Market Week in Review.
Hi, I'm Sophie Antal-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.